Hey, welcome to today's presentation. Walter here, and you may or may not have read the book Naked Forex, which is a book about simple trading systems that I wrote. And today we're going to talk about some of the trading lessons I've learned. This is going to be a lot of psychology and what I've learned to focus on. And I hope that this is helpful for you. I hope that it helps. It's some of these lessons we have to learn ourselves. We just can't. It's difficult sometimes for people to just take the lesson based on what someone else tells you. Sometimes you actually have to go through this yourself. But hopefully some of the things that I share with you today will resonate, and when these things do crop up for you, you find them useful. Or at least you know, oh yeah, I heard that before, at the very least. And we'll also look at the charts today. I'm happy to do that, share my trades, show you how I trade, show you the charts that I'm watching, and all that sort of stuff as well at the end of the session. So probably go about half and half, I'm guessing, or maybe 60-40 with the 10 lessons, and then we'll get into the charts. So if you have any charts, any pairs that you want to have a look at, please do bring those up in the chat box, and we'll have a look at your pairs as well, and I'll share with you my trades and the reasons why I'm watching the pairs that I'm watching. Okay, so let's get rolling. So lesson number 1 here is, these are 10 trading lessons, by the way, myths, lies, and truisms, which are the real important trading lessons. So let's talk about these. So one thing that I found fascinating, because I never really considered that this might be the case, is that you can flip a coin, and that flipping of the coin can determine whether or not you take a trade or not, or whether you buy or sell or what have you, and that those systems can actually work. Now, this sounds kind of weird if you're kind of new to trading, and it's certainly, if someone would have told me this back in 2002 when I first started looking at the currency markets, I would have said, you're crazy. I would have said, you're definitely crazy. Because of course it's all in the strategy, right? Well, it turns out that it's not. And I have lots of examples of this. Probably the easiest way for you to see this would be for you to do this yourself with a demo account, or maybe on a Forex tester account. Just take some trades randomly, flip a coin. You can go to random.org and get a coin flipper tool or what have you, or get a spreadsheet with random ones and zeros or whatever. But and then just take the trades and just set like a set stop loss and a set target, like 5-to-1. So maybe a 50 pip stop loss with a 250 pip target, and just run it like that and take 200 trades and see what happens. And you see what I mean by that. So flip a coin entries can work. And the reason why the flip a coin entries can work, by the way, is because all of the real heavy lifting of your trading strategy has to do with the risk algorithms that you employ, whether or not you're aware of what they are, or you've written them down or what have you, and the way that you get out of your trades, i.e. your exit strategy or your exit rules. Those are the most important aspects of your trading system. Okay, number 2, it's tough to make friends with the trend. Now, if you pick up just about any book that you can find in the trading section of your local bookstore, I was amazed, by the way, to find that Naked Forex was in Thailand. I think I saw it in a bookstore in Thailand. Anyway, that was shocking to me. I didn't realize that it was that widespread, which is interesting. But anyway, it's tough to make trends with a friend. If you pick up any book, a lot of these traders are going to say, "Hey, man, trade with the trend." What's funny about that is that most traders do not trade with the trend. When I'm talking about traders here, I'm talking about you and I. We interact in the retail market. Okay, so I'm not talking about institutions or those who trade on the interbank market. I'm talking about retail traders here. Now, if you look, and I'll give you a great example of this right now, in fact. Let me just pull this up. Let me pull up this bad boy. So this is going to be really cool. When you see this, you'll see what my point is. I'll bring this over for you. Uno momento. Okay, hold on. I'm going to bring this screen over for you from my other screen, and you will see what I mean. Okay. Now, first of all, I want you to look at I want you to pay attention to a couple of interesting things here. I'm just going to bring up like the 2-hour chart just so we can see what's been going on here. Or, yeah, maybe the 4-hour chart. Okay. Now, what would you say about this pound chart, by the way? What would you say about it? Just general observations. This is the pound USD. And as we're recording this, what is interesting about it? Anything at all of interest? Because I would argue that one thing that's pretty clear here is that it's been going down. And I hope this isn't a shock. It's been headed down, right? So the pound is going down. And yet, even though this pound is going down, what do we see over here? 71%, in fact, you can even go back further. 71% of our traders are short the pound, long the pound, even though the pound is in a downtrend. This is not unusual. In fact, this is quite typical, I would argue, that when the market starts trending in one direction, our retail trading buddies, who are also trading the same markets we are, they are always looking to pick the tops and pick the bottoms. That's why I say trading the trend, or it's tough to make friends with the trend. And the reason why I say that is because most traders don't. Most traders don't. I'm just here stating, and I've also surveyed traders around the world. I've given them my trader personality test. And here's what's interesting about it. All of the traders who have done the trader personality test, about 84% of them are what we call swing traders or end of trend traders. They do not like to trade with the trend. And that's why you will typically see, when you see these open position ratios that the retail brokers will share with us, when they share these data, you'll see that across the board. Most traders do not want to trade down, sell a falling market. They want to buy a falling market. And most traders want to sell a rising market. They don't want to buy a rising market. I'm not saying that you should do that. I think it's difficult to change your beliefs. But if you can change your beliefs and convince yourself that this is a good way to trade, I do think it can, in some ways, reduce the pain if you're able to adopt a strategy or two that rides these trends. I do believe that to be true. The most difficult thing is not really finding a trend trading strategy that will pull profits, but rather convincing yourself to do so. And I'm reminded of a course that Richard Donchian taught about trading. Richard Donchian, of course, was the forefather of these automated trend trading systems that people like the Turtles traded. If you've read the Market Wizards book and the new Market Wizards book by Jack Schwager, you know all about the Turtles. What's interesting is that these Turtles, their system that came from Richard Dennis and William Eckhard, it has roots in the Richard Donchian trend trading strategy. So what happened was Richard Donchian came up with a bunch of these rules for trading the trend, and he programmed them, and he was able to show that, they made money looking at historical data. And when he taught a course, it was a 14-week course at a local college. I don't know where it was. I wish I could find this reference. He spent 2 weeks telling all the students, explaining the trading system, which is essentially what the Turtles traded, the 55-week breakout high or low or whatever. And then I think there was also like a 21-week breakout too, or something like that. 21-day and a 55-day breakout, and then a 21-day breakout or whatever, and then a 10-day exit. But it doesn't really matter. The point is, I have the rules. If you want the turtle rules, I can give you the strategy. But the point is that he spent 2 weeks explaining the strategy and 14 weeks trying to convince them that they should always trade the strategy. That once they started trading it would be difficult to keep doing it because people don't like to get whipsawed, and people in general don't like to trade with the trend. They like to trade against it. So I'm not telling you that you should trade the trend. In fact, if you're new to trading, I don't think you should if the trend doesn't make sense to you. If it does, of course, do it. I think in the beginning, we really want to embrace strategies that make sense to us and that are in alignment with our beliefs. It's only later on, as you get more experienced as a trader and you see different markets, that you might want to consider adopting strategies that require you to change your beliefs a bit. That's all I'm saying. So hopefully that helps. Let's go to the next one. Start with your trading beliefs. So this is kind of related, and this is the idea that if you're going to build a strategy, you want to come up with a system, and you're not going to follow somebody else. You can take the seeds of another system and use that to grow your own. What you'll find, I believe, is that it's the path of least resistance, which may or may not be the best path for you, but the path of least resistance is that path where you build a strategy based on your beliefs. Okay? Really important to remember that you're starting with your belief, which is, hey, the best place to take a trade on the chart is at the turning point. Okay, then build some sort of swing trading strategy, or maybe an end of the trend strategy or something like that if that's your belief. If your belief is the best trades often occur right after a very quiet, tight, range-bound market breaks out and starts moving quickly, then trade a breakout strategy. Whatever, it doesn't matter. The point is, starting with your beliefs is really the way to go. Okay? Alrighty. Cool. Next. Trading is about challenging your beliefs. So one of the things that happens over time, the longer we trade, is we get exposed to ideas or experiences that are going to challenge what we believe. And so what arises essentially is cognitive dissonance. And you have a choice. You can ignore it and say, well, that's irrelevant or whatever, and just write it off. Or you can try to assimilate it and adapt your beliefs to this new data. So when these new data come in, you really have a choice. And most people will just come up with a reason why they should ignore it. You'll see this in science all the time when they talk about removing the outliers. Well, unfortunately, in trading, we cannot do that. We will have outlier trades. We'll have good ones and we'll have bad ones. The bad ones where we lose much more than we expected to, and then the good ones where we win more than we expected to. And we cannot remove them. We're not scientists. We can't just take those data and just throw them away and say, then we'll remove the outliers. No. So what happens over time is we become, as traders, typically more flexible. Typically, you'll become more confident in your strategies, but you'll also become more flexible in the way that you see the markets. So, for example, the way I see the markets, and I'm not saying this is the best way to see it for anyone, is basically there's only a couple of different types of markets. There are very volatile range-bound markets. There are low volatility range-bound markets. There are high volatility trending markets, and there are low volatility trending markets. And that's about it. It doesn't really matter what the micro is, what the formation is, what the pattern is on the micro. The big picture is the market's either trending or it's not. And if it's not trending, it's either really, really quiet or it's not. And if it is trending, it's really, really, really quiet while it's trending or it's not. And that's about it. So I don't really care if the market is, like if I'm a breakout trader, it's going to matter to me if the market's really tight in a range. And I'll show you some examples in a minute. But if it's really tight, that's going to matter to me. But if I'm, if I'm a, like a swing trader, it may not matter as much. Like I might be as happy to trade the support and resistance levels if it's volatile or if it's not volatile. So it really is about challenging your beliefs. So over time, you may come to the realization that I have, which is, look, trading systems can work whether or not there's any logic behind it. And today now with our computerized strategy builders, where you can build like AI-based strategies or machine learning to build strategies, a lot of times when you see the strategy, you're like, that doesn't make sense. Why would I just sell the euro every day at 4:59 p.m. New York time? Why would I just do that? That doesn't make sense. Well, that's one of those things that it's going to challenge your beliefs. I mean, like, I can look at the data and it says, yep, it's going to make money. It's made money. It's made money for 15 years. So why is that? Even though it doesn't make sense, it doesn't mean that it's not a viable strategy. So there are a lot of things that we as traders have to learn over time. And one of them is definitely to reconsider our beliefs. Number, 4 or 5, you can tell a trader's experience by his foci. This is really important. So I was working with a trader, and he was a pretty cool guy, and I enjoyed, he helped some of my students, and he was quite interesting the way that he looked at the markets and the way that he taught trading. And then one day I was talking to him. I said, "So what have you been doing for your your trading psychology? Like, how do you deal with that?" And I was expecting to hear some sort of regiment, well, I do this and that, and I always blah blah blah, and I have these rules and this and that. And he goes, "Oh, I don't have any problems with that." And so it's not funny, but right away I knew there was a problem, because I knew that this trader probably wasn't all that he was cracked up to be. And because he wasn't really working on improving his trading psychology, I thought that he probably wasn't as advanced a trader as he was letting on. And so what I mean by this is that if you're focusing on finding a strategy, like a viable trading strategy, then chances are you haven't been trading very long. If you're focusing on changing the exit rules of your strategy, then chances are you've been trading a little while. If you're focusing on the risk management side of trading, then chances are you've been trading a while. And if you're focusing on the psychological side of trading, and the mindset and your beliefs and your challenges and your emotions and how to deal with that, then I can almost guarantee that you've been trading a long time. And that's what I mean by whatever your foci is tells a lot about where you are. There's nothing wrong with that. It doesn't mean that because your foci is on developing strategies or finding viable strategies, that's totally cool. I'm always that's something that I enjoy doing. That's the creative part of trading, is coming up with new rules and strategies. Most of them are junk and I throw them away, but some of them end up, coming along they're pretty good, and they'll move along to a live account eventually. But that's not always the case. So if you're wondering about where a trader is along the journey, or wondering where you are, just know that typically what happens is you go through the stages of looking for a system, and then changing, then looking at exits, then looking at risk, and looking at psychology. Those are the things that we look at, and that's typically the order that they go in. Or, risk and psychology kind of come in around the same time. So there you are. Another one is that you can win often or you can win big, but you have to choose. So in other words, you're not going to do both. And what I mean by this is a lot of traders, they want to take a lot of trades and they want to compound their accounts. I think there are really good ways of doing this that may or may not involve taking 10 trades a day. But what's interesting is that oftentimes those traders who take a lot of trades, they often get very little out of those trades. And that those traders who take a few trades, they often get a lot out of their few trades. So if you have an 85% win rate, I can almost guarantee you that your reward risk ratio is upside down, that you're risking more to get less, risking $1,000 to make 500 or $1,000 to make 600 or something like that, or worse, risking $1,500 to make $600 or something like that. And that's typical of scalping strategies. The focus for those traders is going to be on execution and in getting that right, because if you mess up the execution on those, you can really get hurt. Now, the other way to do this is to simply win big, and that means you don't necessarily have to take a lot of trades, and you certainly don't necessarily have to have a lot of winners. You can win. I have a system that I've been testing. It wins 28% or 27.9% of the time. So 28 times out of 100 it'll win, and 72 times out of 100 it'll lose, and it makes really good money. The reason why, of course, is because the winners are way bigger than the losers, right? That's where the edge is. So I want you to remember that you need to choose. For any given strategy, you need to choose. Either I'm going to win a lot, and they're going to be small little wins, and when I lose, it's really going to hurt because it's going to wipe out a lot of wins, or I can win big, and that means I got to take a whole lot of losses waiting for that next win. Another thing that I've learned is examining trades in clumps. Now, this is just good science. Like if you have any statistics background, you'll probably know about this. But typically, what happens in statistics is you don't just sample one thing. Like you don't take one sample and then go, "Oh, we know what's going on here." But yet, as traders, it's very tempting to, isn't it? Like, oh, I think I'm just going to take this one trade here and it didn't work out, so now I'm going to completely change my strategy. And that's not the way to do it. Unfortunately, that's definitely not the way to do it. So the reason why I say this is because it's a big thing, right? Like we have this problem as traders. We take a trade, it doesn't work out, so therefore we have to fix it. My suggestion for you is that you take a look at your trades in 30 trade clumps. So if you're worried about whether a system is working or not working, wait until you have 30 trade a clump. If you're concerned about your win rate being lower than you expected it to be based on your backtesting, wait for a 30 trade clump. So you take in these trades in groups of 30 and add them to your aggregate data, and you cannot make any decisions until you take in another 30 trades. In this way, you're getting a sample of trades from the universe of trades available out there based on your system's rules, and you'll be much more likely to make the right decision. Because I know it's easy and it's difficult psychologically to withstand an 8, 9, 10, 15 trade drawdown, but the reality is it should just be bad luck. It shouldn't be that something is broken. It could be that your execution is off if you're doing, if you're trading discretionary systems like most of us are. It could be that, but it's probably, if everything's right, if you have everything about right in terms of your execution, it's probably more along the lines of bad luck, even though we like to ascribe something else to it and say, well, it's because of this or that, so we have to change it up. And this is kind of related to this idea of bad luck. So bad luck is not a reason for changing your system. If you have a drawdown and the last 10 trades have been losers, it's mostly bad luck. You can statistically take a look at that and say, wow, how likely was that to happen? Should I have expected this? Let me give you an example. Actually, I have this calculator that you guys can use. I talk about it all the time in my podcasts and everything. I always seem to bring it up. It's fxjake.com. It's free. You just go to fxjake.com/risk, and you can plug in your trade data, And on this page, you will find, here's a little video on how to use it. You can make it bigger here. You will find how likely it is. So if I have, like I was saying, I'm at my 27.9% win rate system. I'll just put it in as 27. It has a 3-to-1 reward risk ratio. Actually, it's 2.99. And then if I'm risking 2% per trade over the next 10,000 trades, what are the chances that I'm going to have a drawdown of 30%? It's 100%. So the fact that I have this drawdown, actually in my back testing, I do have a 30% drawdown right now. And my question is, well, what's going on here? Why? Well, the answer is there's no real reason. It's part of the math. The only way I'm able to avoid this 30% drawdown is to either increase my win rate, which I'm not going to do. I'm happy with my system. Increase my reward risk ratio, which will affect the win rate, of course, or decrease the risk amount. And it looks like to avoid that 30% drawdown, I'm going to have to get it down to maybe like 0.2%. Yeah. So if I'm risking 0.2%, then I can avoid that 30% drawdown most likely. But otherwise, if I'm going to trade 0.3, 0.4, or 0.5%, so at 0.3%, I've got a 1 in 10 chance basically of hitting that drawdown level. So that's important to note. Know your numbers and know whether or not you are experiencing bad luck or you are simply or something broken, right? It's usually going to be bad luck as long as you're executing correctly, as long as everything is in line. But occasionally a system will go awry. My experience has been the systems with more complexity are more likely to go awry. They're also more likely to be based on prior data, and in other words, be curve fit to prior data, which means you're not really trading a system that's robust and it's likely to work in the future. The simpler the system, the better. I like very, very simple rules for my strategies. And I find that to be useful. And I'm not the only one that espouses simple ideas, but that's the way to go, I think. Okay, let's keep going. Risk algos are amplifiers. This is interesting. So you can drastically improve a trading system by the way that you change the risk rules. This is something I've been working the last couple of years on, and I've made great progress. I'm very excited about what I've learned along these lines. However, all it really does, like an amp, I'm not really a musician. I used to play the steel drums, if you know what those are. But people used to look at me funny when I carry around this oil drum, or the half an oil drum, and put it in the back of my truck and go out and play it someplace remote. And but then you can amplify anything. You can amplify a guitar, but here's the thing. If you're crap at playing guitar, all you're really doing is allowing more people to hear how crap you are at playing guitar. And that's the same with your algorithms that you use with your strategies. It can amplify a system that has if it has a positive expectancy, it's expected to make money, you can really blow that up and improve it. Or if it's a bad system and it loses money, you can really amplify that and make it worse. I just think it's fascinating how you can fine-tune your trading results based on this idea of the risk management. It's really a cool way to change your trading altogether and to change your suite of systems. Discipline applies to risk and execution. What does that mean? Discipline applies to risk and execution. What it means is when you hear a lot of traders talk about discipline, you must be disciplined. All of that is true. Most of the time we have to learn these lessons ourselves. So if you read like biographies of famous traders, a lot of times or interviews, they will talk about a situation where they lost a lot of money and they vowed never to do that again. That's a very common sort of theme. And that applies to being disciplined in terms of the amount that they're going to risk on any given trade. So, and that's true. And a lot of traders understand that this is true. But if you want to really get good at this, you also have to be disciplined with your execution. So not only do you have to be willing to say, look, I'm only going to risk this amount, and if my drawdown gets to this level, I'm going to turn it off. And these are, you have all your rules set up in terms of what's going to happen if you hit your drawdown. Well, you also need to have all your rules set up in terms of how do I get to a point where I'm executing my system as I should? What do I need to do to get to a point where I am doing exactly what I need to be doing? And that's important. A lot of traders don't do that. They have no idea how to keep their eye on the ball. They just say, I'm going to keep my eye on the ball. Well, that's not good enough. What can you do to ensure that you are focused on executing your strategy, knowing that the money will come? There's a really powerful statement there. The money will come if you follow your trading rules. Do your trading rules make money? Yes. If you follow your trading rules, are you going to make money? Yes. So what are you going to do to make sure you follow your trading rules? Well, I don't know. So that's important, guys. Really important that you set up a structure that enables you to follow your rules. That can be rewarding you for following your rules. That can be a trading accountability partner who's going to ask you, let me see your trades this week. Did you follow your rules? A lot of really valuable ways to do this. I just want to make sure that you're aware of the fact that it's when they talk about discipline, it's not just risk. It's also execution. And that's the end of the 10 trading tips and tricks and realities. I hope that you've enjoyed that. And there's a bunch more in here, but we're just going to stick to those 10. All right, so let's take a look at the charts, shall we? Anybody interested in any charts you want to have a look at? We've got some time here. I'll bring over my screen. Which charts are you guys looking at trading at the moment, or do you have any that you like? I'll share with you my trades, okay? So here are my trades. So here there's a couple I'm actually looking at here. I want to sell the pound Swiss, but I didn't want to sell it off this move today during the Asian market. So I decided I'd wait to see if it comes back up, and you can see, yes indeed, it's coming back up. So I am probably going to sell the pound Swiss. Pound. So Ivan, I'm in a pound trade. I got in a pound trade last night. And my pound trade was right here. I'll show you. It was right here, this bad boy. Boom. Okay? So this is a sell down here at, I think it was 26.05. My stop loss is up there at 38. So it was 33 pips of risk. And I've moved the stop to break even. So if this move gets back up to my entry price, then I'm going to get stopped out. And I'm kind of waiting for it to go much lower. But right now we're in a little bit of a retrace. I expect that we will see this market go lower, but we'll see. We'll see. See if it happens or not. So, okay, and one of the reasons why I want to talk, let's talk about this. One of the reasons why I think the pound is due to go lower is because the numbers, so I like to follow what the retail traders are doing because I do the opposite. So if I go, pound New Zealand is another one that I'm actually short right now, but you asked for the pound, so we'll talk about, I have a very similar position on both pairs. And I consider them to be independent, even though there's going to be some correlation here. But if you look at the pound, most of the traders are long the pound, so I know that this is a strong downtrend. Because remember, we were talking about this. Traders go against the trend, and when most of the traders are going in one direction, that means it's a strong trend. So this is a very strong trend for me, 70% or more. I think this is updated every 10 minutes. The other one is the pound New Zealand, which is not as strong. It was stronger 2 days ago, but it's not as strong as it was. Typically, this number will roll over a bit and go back as the market retraces against the trend. This number will come down, and then when the trend takes off again, it'll get back up above 70. 70 is kind of my cutoff level. So let me share with you. So I shorted here on this kangaroo tail in the 1 hour. It went 3R in my direction. So and I'm looking for 5 or 10R on this one. And then the pound New Zealand is right here. It's right here. And similar trade right here. This one has come back pretty hard. And same thing, I've got my break even stop here. So if it hits this level, which is, I think it's 55. I think I sold at 56. So if it gets to 55, I'm out at break even. And this one was up about 4R actually down here this morning during the Asian Open, and it's come back up pretty hard. The original stop loss was on the other side here. It was like 51 pips of risk, which is kind of the max that I will take on these 1 hour chart trades. You go 45 to 50 pips on the big, really volatile pairs, and then 35 to 40 pips on the like Kiwi, Euro, Pound, like the ones that aren't nearly as volatile as the Pound Aussie and the Pound Yen and so forth. So those are the two trades that I'm currently in. That's it right now. I'm not in any other ones. Any other charts you guys want to have a look at? You can certainly do so if you'd like. So the other one the other one I like in terms of a possible trade is the pound Swiss. I think that it fell and we've just retraced up to this level here. See where these lows are? I think that's what's going on here, that we've just kind of come up to there. So I think this is the resistance level that's showing right now, and I don't think it's going to get much further. In other words, I think it's probably going to double top up here. I think we're going to see this move up. I don't know, maybe not. This is a pretty bullish candle, but we'll see what it does when it gets up here. I think it could consolidate here too. It could just turn into a box here for a while before falling again. But if you look at the numbers, the pound Swissy, I think, is a pretty good bearish. Pretty good bearish trend, I believe. I think most traders are well long. Let's see. Double check on this one. Oh yeah. So look, 76% of our traders are long pound Swiss. This is a great downtrend. So I am keen to pull the trigger on any sort of a reason to sell up here. I would be exceptionally keen. No. Okay, Ivan's question is, if you see the ratio at 50, and by the way, you can get the same numbers from Saxo Bank, Owanda, but I like IG because they have a lot of these pairs that I like to trade. Like, I love trading the Euro Kiwi and the Pound Kiwi and the Pound Aussie and the Pound CAD. You know, these really volatile pairs. They're like, it makes trading fun for me. Trading, you know, the Swissy, not so much fun. So, yeah, and it's not, so if it's at 50, like, I'll give you an example. I think the euro is around 50, right? Whoops, wrong one. So let's find one that's not very exciting right now. Like the Swissy is not very exciting. Okay, so the Swissy is kind of boring because the number is going to, I'll tell you, it's going to be like 52 or 48 or something. Yeah, okay, 54%, right? So that means nothing to me. What it basically means is there is no trend, because you can, as sure as the sun's going to shine tomorrow, we know, well, I guess maybe not if you're in like Finland or something. It's like the middle of winter. Sorry, that was probably not a good analogy. I forget that it's only summer in Australia. It's only summer for us down here in Australia and Brazil and whatever. Here's the thing. 50-something% in that range, that means no trend. But as soon as it gets over 70, then yes, it's a trend. Now there is the occasional time when it will say like 70% of the market is long, right? And then you go to the chart and it's an uptrend. Well, that's weird. It did happen on the Euro Aussie, actually, I think. This year on the Euro Aussie that happened. But typically that won't happen. So just to quickly summarize my rules, you know, we do a webinar basically on this stuff every Monday evening. If you're in Europe, it's around 11 p.m. Sunday night, right when the market opens, an hour after the market opens, basically. And if you're in New York or the Eastern time zone in the States, that's basically 6:10 p.m. Sunday night. So it'd be 11:10 p.m. if you're in London. But whatever, we talk a lot about this and we follow this. But essentially, as soon as the market gets over 70%, I'll go to the chart and confirm that, yes, in fact, the chart is going the other way. And if it is, then I'm very keen. Like the pound Swiss is just a classic example of this. So yeah, pound Swiss is probably, I don't want to say for sure, but very likely to be my next trade. And obviously it will be a sell trade. Yeah. I don't wait for a break. So I don't get excited about the 50%. It only really catches my attention once it gets over 70%. And remember, the numbers are refreshed every 10 minutes, and if the numbers pull back a bit and get to like 66% or whatever during a retrace move, that just means that traders are getting out at small profits or at smaller losses, basically, right? Because all these traders are trying to pick the bottom on a downtrend or pick the tops on an uptrend. The numbers will move. On a pullback, the trend will weaken, basically, right? It's going to weaken. But if you've been watching the pound Swiss today, it hasn't weakened at all. Even though the pound Swiss is going up, these guys are still buying hard the pound Swiss. So I'm very keen to sell it. Does that make sense? I hope I didn't completely confuse anybody. Yeah, cool. All right, yeah. So it's really a trend indicator. So you're going to see the number get over 70% when the trend is in full force, and when the trend pulls back and there's a little retracement move, you're going to see it. You're going to see it shave off a bit, and you can actually, in some tools, some brokers will show you where all the orders are. You can see where the stops are, where the take profits are, and all that stuff. You don't have to. I don't think you have to get into it that much. I just use it as a trend indicator. So right now, if I look and say which pairs are trending the hardest, it's pretty easy for me to go pound Swiss. I think Euro pound is probably going to be another one, but I'm not sure. Let's have a look. Euro pound just did what we call a last kiss, or just broke out of a box. It didn't really give the last kiss. I was kind of waiting on that. 69% are short, so yeah, it's up there, but not nearly as good as the pound Swiss. And then what are some other ones? Like what's the Swiss yen? Because I really want to sell the Swiss yen, but it's not high enough yet. Yeah, so Swiss yen, here's another interesting chart. So you can pull up the Swiss yen and you can look at your trend line here. Like, here's what I'm thinking. Okay, I'm gonna go daily just because it's easier to see it. But so this is the trend, right, on the Swiss yen, and see how it's come up here. What did it say? 69% are long or something like that. So when it comes back down here and breaks this trend line, I'll get in on the move back up. It'll come back down here and eventually it's going to break this trend line. If the numbers are still good and everyone's still going long, then I'll short it. And I will target, let's say that it breaks here, falls down, comes back up and touches here. I'll short it here on the bearish candle and I'll target like way down here, you know, make it a really good risk to reward thing. 110.55 or something like that. Cool. Any other questions, guys? I think we're running out of time, actually. Any other last minute questions about any of this stuff? So, and when that happens, like when it goes down, I would expect this to get over 70% too. So that's another pair that I'm watching. Definitely the Swiss yen. Alrighty. Well, thanks so much for spending time, guys. I wish you very happy trading. We'll see you next time. Thanks for spending time here. And I wish you happy trading. Thanks, guys. See ya. Bye.